Good morning. We're still awake this morning? You know, when Dave originally talked to me about speaking about myths in the farm equipment industry, he came to me and asked me about speaking about market share and profitability. And I said, I'm not sure that's a good idea to put a target on my back within the first 30 days of me taking a new job. And, you know, market share certainly is what the manufacturers are all concerned about. And I'm all for growing market share as long as we grow our new market share and our used market share at the same rate. Unfortunately, manufacturers often don't get that. The other thing that I'm all for is doing that at the same time of keeping our balance sheet metrics in balance and keeping the whole organization going the way it needs to. It can be done, but it's got to be done in a very measured, predictable way. And we can't chase market share and forget everything else we know. But what I do want to talk about this morning is the myth that outside capital is necessary for acquisition growth. You know, there's lots of ways to grow our business, and we heard some of those earlier. You know, I have the most respect for Dave Meyer and his group for going public and all the hoops and requirements that have to be jumped through to do that. And it's a phenomenal story and a great success story. And yet, you know, for all of us, that's not the right way for us to go, and it maybe doesn't fit our culture or just our individual styles. You know, we've looked at a lot of these different alternatives. Going public. You know, Dave talked a little this morning about private equity and the challenges you have there, and kind of selling yourself out to somebody on Wall Street, and you get 3 or 4 MBAs coming in running your business, and then you've got the risk in 2 or 3 years of not getting the acquisition growth or the profits, and they want to yank their money out. And we are all as concerned as we look at growing our business of how do we do that profitably, how do we sustain an owner profit and a return for our investors, but how do we take care of our customers in a long term and have a consistent relationship with them? How do we value our employees in that process? And so, you know, private equity was not a route that made a lot of sense for us. You know, in the early years we did some mergers. We brought some entities together. That has its challenges and it has its places, and many of us have grown at some points through mergers. But sometimes you get a clash of cultures and a clash of ideas, and there's a lot of work to move yourself through that process to get to operate as one entity. And then there's always the route of additional capital. For those that have deep pockets, we can always put more money into the entity to fund acquisitions and mergers and growth. But for us, that wasn't what we desired to do. And sometimes we get into the myth of believing that this outside capital is a necessity for us to move forward and grow our business. And I would submit to you that with good cash flow, with good management of our balance sheets, we have the ability to generate returns inside our business and to put those to use to grow our business. It can absolutely be sustained over the long period. We at Birkey's have grown our business 600% in the last 12 years with no outside capital, and at the same time we've repurchased and bought back about 20+% of our stock. Has it always been easy? No. But we've had a lot of discipline over those years to just continue plodding along that same path. Now, there's some disadvantages to this kind of approach. You know, it won't fund the kind of rapid expansion that a public entity can do, and it won't fund the kind of expansion that private equity, where you've just got a balance sheet flushed with cash. But that wasn't our goal. We may miss some opportunities. There's opportunities sometimes the timing's not right. And when you're reinvesting your own capital, you're taking monies that your company is investing, and it may not be the right time. You may find that an opportunity comes and you're not in a position because you want to manage the leverage and the asset turnover and the inventory turns and everything else in your business to do that. So there have been opportunities where we've had to walk away. Now, some of those have come back. We had one 5 years ago that went away, came back to us this summer. We did an acquisition this summer, and it's worked out very well. But you can miss some opportunities in the marketplace using this kind of approach. And it will not work if the only thing you're going to focus on is sales. You've got to have a discipline to focus on the balance sheet, to focus on the metrics, to keep those things in check, those drivers that generate the kind of cash flow and asset turns that give you some monies to move forward with. So what are the advantages? Number one, ownership's not diluted. That's always the challenge on a lot of these where you're taking money from the outside, is your ownership interest gets diluted, and often your input into the organization, your ability to run the organization and create the culture and the climate with your customers and employees, you give up some of that in some of these other alternatives. So it's an advantage to be able to do this with internal funds. Integration of your company culture is easier, and your values. Sometimes that's difficult. It comes slow when you merge entities and come together. But in our particular situation, we may add 1 store or 2 stores at a time, and we work very hard to bring people in from our other locations to integrate the values, the cultures, the procedures, all these things that make a Birkey store. And the growth is more steady, and it allows you to grow your ownership, your management capabilities at a pace that goes along with the acquisition of the stores. Some of our biggest challenges is not, as we heard this morning, letting that growth get out ahead of your ability to manage it. And it continues to be a challenge, and we work on it, but it's much easier when you grow your business this way. Discipline is required. One of the things that we committed to do probably 15 or 20 years ago is the owners had a willingness to retain profits in the business and grow the equity. Because in this kind of a situation, you're going to be dependent upon that equity growth as well as outside borrowing to fund your business. And you've got to have a relentless commitment to manage the balance sheet. You got to have good, high integrity information. That's one of the things we find as we go out and look at other dealerships is the integrity of the financial information is often very suspect. Dealers know what they sold, but there's a lot of other tracking as far as inventory values and the values of assets and a lot of other things that isn't very good. And so we have just a very high commitment that we have very good quality information. And we monitor it, we report it, we share it, we open our books. And you got to have reliable banking relationships. Talking about the reinvestment of profits, you've got to be relentless in your commitment to grow the equity. Okay, in just purely mathematical returns, a 5% return on sale and reinvestment of all the after-tax profits will actually support doubling your business about every 3 years. And that's assuming you can find the right acquisitions and the right timing to bring those in. But from a number standpoint, you can double your business every 3 years. You can't put all the earnings out of the business and expect to generate using debt only. The bankers don't like that. The leverage ratios get out of whack. They want some skin in the game on the part of the ownership. Let me just give you a scenario here, and it'd probably be a little bit hard to read. But if you had a dealership with beginning assets of $10 million, $2.5 million of equity, asset turnover ratio of 3, you make a net income of 4% pre-tax, 40% tax rate, and let's say you distribute 10% of the earnings out to the owners each year, you're going to target 10 times sales to equity and keeping your financial leverage at 4. I know you can't read this table very well, but just doing the math, I put this in a simple spreadsheet. You start at $30 million of sales. In 10 years, you can be at $207 million of sales, and you can grow your equity from about $3 million to $21 million. And this is the kind of scenario that over time we have continued an organization to do to grow our business. You got to have controlled growth. You got to control the leverage in your business. Your financial leverage is going to move up when you do these acquisitions if you use debt financing. The key is find the right opportunities, pass on the ones that don't generate enough sales and net income and cash flow, and then get that equity coming in so that you can reduce the debt and the leverage in the organization. We try to keep this in that 3 to 4.5 range. Okay, so there's our goal as I just stated. Use turnover as the key. If there's one thing that we have focused on in the last 10, 12 years, it's use turnover. We target use turnover at 4. Anytime our use turnover goes below 4, sirens go off, alarms ring, and we get after it. And we are talking about use turnover every day, every week, every month. We align everything that we do to achieve that 4 times turnover. And it's hard. You've got to work on it. And there's a lot of things going against you. And use turnover can certainly go south if you chase market share too hard. But it can be done. When you think about moving from a 2 to a 4 times turnover, you actually have cash in half of that inventory to invest in another location. If you got 3 or 4 locations and you can raise that use turnover, it creates a lot of cash flow. All right? And then quality information. Invest the time to get a solid budget. We've heard this earlier today with Dave and some of the things that he shared about going public. It relates to having good banking relationships as well. Create consistent, high-quality financial reports. Share your goals with your managers in your company. Be proactive. Open, honest with lenders by sharing information monthly. We've done that for a long time, and we have very good relationships, and we could not do what we do without our banks. And have your statements audited. You know, reliable banking relationships are key. You know, if you want to maintain a financial leverage of 4 and grow at the maximum rate, just think about you're going to be borrowing $3 for every dollar you have invested in the business. So they want to know that you know what you're doing and that you've got a plan and you're managing it. Okay? They're your greatest allies, and I got to wrap up here. Thank you so much. Appreciate the time. Certainly can share more information with you later.